So thank you very much, Greg. We're going to talk about several cases for about 10 minutes each. I'll start talking about some New York cases, and then Yu-Ning will talk about her work at the ERA in Singapore, and then we'll hear David Joy about London, rail, about King's Cross, and some other developments. I think everybody in the room has had some experience with public-private partnership projects. I'm an architect, so I feel a little bit in those projects. I'm the sort of football between two teams, hopefully not getting kicked too hard, but my perspective is as a designer, so keep that in mind. And here in the Jing'an Kerry Center, which is a project that we designed about 10 years ago, I was talking to the developer yesterday, and this is the Kwok family who developed this project, who said, of course, in China, the government is always your partner. Every project is a public-private partnership. And then talked about various ways in which members of the district would come by the property and talk about which shop should go where, what they should do about security, et cetera. So keeping that in mind, we'll move from New York, which is perhaps, of the three, the place which has the weakest government participation in big projects, to Singapore, where perhaps we find the most, and then London in between. So let me begin talking about a couple of cases. The first one, Hudson Yards, and I was just at a session of the Urban Design Forum in New York last night, where there was discussion between the city and the developers and some journalists, and quite a bit of suspicion coming in the New York context about whether or not the public should be in bed with private development. But here you see about 25 acres of industrial land, of rail yards, which now spawns already, this is a photograph, not a rendering, the first phase of about $25 billion eventual build out, but this first phase being about 10 million square feet. So the mechanism that allowed this to happen had to do with a grand agreement between the developers related, their partners Oxford, and the City of New York, Michael Bloomberg, but also the MTA. So it reminds us that in public-private partnerships, often the public is represented not by one, but 2, 3, 4, 5 different bodies. You have in New York, state, city, federal, MTA, Port Authority. And so, but it had to come together in some way. So in this grand handshake, the city decided it would put up the money with a bond issue to build the number 7 line. Transit was the key to this all. But then after that, the MTA would lease the land above its rail in layers to related. And the leasing of that layered space has some correspondence to the market. Eventually, if there's an uptick in rents, that rate of lease can be raised as well. In the whole plot of land, it is not all private. There is a public culture shed. The element of culture, very important. So that enters the equation. So you have these various parties coming together to make what so far seems to be a very successful making of place, and for the city, a huge amount of tax revenue, which is already far outstripped the debt service on the bonds that were issued to create the number 7 line. And you can see here, this is the kind of project, and David will speak later about some more rail projects where public-private partnerships are almost required because of the anatomical intertwining of rail below and buildings above. How could otherwise these different structures coexist? You see here the way in which about a 600,000 square foot retail building is suspended above tracks. So who will pay for that? And that's part of the public-private deal that is made. In the end, there is a great space. These are buildings you see designed by a number of architects, by Norman Foster, KPF, Skidmore, Owings and Merrill, Diller Scofidio, and Thomas Heatherwick's Vessel in the middle. Now to shift over to another Manhattan project, which is not as complex public-private partnership and a much smaller piece of land and development case. Still interesting to think about. And this is the One Vanderbilt Tower, which will be the tallest office building in Midtown Manhattan. And it arose because of a need which the public saw to densify Midtown and Midtown East in particular, where buildings from the 1950s were not economically efficient. They were not attracting the best tenants and the best rents. And the answer was that more density would be invited into various sites strategically. And at the same time, there was a need for some greater density, or a reason for it, because as you see in these images of these tunnels below Grand Central, the ridership of Grand Central Terminal will, at peak hours, double due to the introduction of new lines leading to Long Island. And so this particular piece of land, which was owned by S.L. Green, became the sort of bypass in this operation of densification to allow pedestrian traffic to come out of Grand Central into a private building, but with public train halls in its ground floor. Now, so the deal was that with the introduction of those train halls and space at grade, the developer in this tall building would be granted another 500,000 square foot of development rights. So there was a kind of a swap, but also S.L. Green has to execute on the improvements of $220 million of improvements to tracks, platforms, and stairways in Grand Central. So there was a deal. There was a cordial entente made between Mark Holliday from the private and, in this case, the city planner, Amanda Burden, the public, but many others on both sides of the public and private equation as well. And here you see the rendering of these two buildings, the public train hall and the private building, coming together, and the building as it arises. Now it's sort of not quite topped out. So before handing it over to Yu-Ning, I just want to, for the discussion that ensues, talk a little bit about the context that we find ourselves in today. Many of in the audience are not spending all of their time in China. Many are and know this very well. But the whole sort of mega development of the Lujiazhui in Pudong, as most know, came about because of or with the help of the Lujiazhui Development Group, which then disposed of land and went into partnerships. Some of the audience are involved in those partnerships that vary in their ownerships. So here, in the case of Kerry Parkside, the same developers who sponsored this project have a majority stake. Here you see the result of the building off of Century Park in Pudong. In other cases, and we see a map here of the Qiantan area, in the evolution of Lujiazhui, one step further along, but a variety of projects. This is a Tishman Spire project, and you could see this pie chart, their ownership of 35%. So Lujiazhui Redevelopment Authority can sell the land, but it can choose to maintain a significant ownership portion of a major piece of the puzzle in the Qiantan area. So that's one good example. Another is the Qiantan Center, which, although it appears to be all LJZ, state, in other words, or a company owned by the state, Shangri-La has the option not only to operate but to buy the hotel. So it really is a joint development. And here you see that building, which is actually now topped out and being completed. And so for a future discussion in the ensuing 15 minutes after we finish our talks, we'll talk about China a little bit. So Yu-Ning.
Yep. Thank you. Thanks, Jamie. And I'm going to be talking more about at a larger scale, talking about the city planning. I'm from Singapore. And in our case, it's really, I want to focus on the CBD location. Just kind of winding back to where we started. This is way back in the 60s when we started. It really was very congested situation, poor sanitation, under provision of housing. So there was a need for a modern business district. And as some of you recognize, right on the top picture on the right-hand side is the Fullerton building, which is today the Fullerton Hotel. There was some beautiful old stock of building, but there was also a lot of problems with the fragmented ownership of the old neighborhoods and all that. So we put in the Land Acquisition Act to help facilitate the amalgamation of the fragmented lots. And through various private as well as public developments, public mainly through the government land sales program, we managed to redevelop the CBD. This is back in the 70s. And with the gazette of what we call the Golden Shoe, which was the CBD back then, we managed to help take away rent control problems and help facilitate the redevelopment. And then bottom picture, you saw the subsequent result of that. And fast forwarding to today, since the 80s, we've put in land reclamation. We've further extended the CBD out into the Marinas Bay Area with infrastructure provided by the public sector, with a lot of other facilities and infrastructure provision. So what you see is in the bottom picture. But as we proceed, the current challenges are the old CBD that we built way back in the 60s and 70s, changing economic needs, changing workforce needs, and changing trends. We're seeing a lot of infrastructure, aging stock that we need to kind of try and revitalize. And the mono-use office district is no longer working well for us. There's a lack of activities outside the office hours. But we no longer have the state land that we used to have to work with. So we got to go in and look at other ways that we can encourage the redevelopment and rejuvenation of the area. So the vision is really to, in the blue color, you see the mono-use structure plan of the CBD. And it's really trying to loosen it up, to try and introduce more mixed-use development, to make it a more vibrant, more connected CBD, more inclusive space. And how do we do that? Because it's actually basically all in private ownership. So what we're going to be putting in place is trying to further tap on the private sector ability to bring in the capital, bring the business ideas, bring the entrepreneurial capabilities, and on the private sector side, to get them to encourage that redevelopment to happen. So it's really about working with the markets, understanding what they need, and from the public sector side, putting out the vision, some of the ideas, and the plans to encourage that to happen. So of course, we still have the GLS, the Government Land Sales Program, where we can introduce some developments, and in the picture you see the Tanjong Pagar Center, which is one of the winners of the ULI Asia Pacific Awards. And the Government Land Sales Program is about trying to provide transparency, understanding what the market needs, providing enough flex in the planning parameters for the private sector to come in with their ideas within the urban design and the development proposals, to put in that common understanding of what's going on around in the context, but still giving space for private sector to initiate new ideas and encourage kind of innovation from there. So within the development, which is in the picture that you see there, it's providing an opportunity to reposition the area as a vibrant mixed-use area. And within the guidelines, we've given some ability for the developer to provide the users, but also to work with them to look at what are the additional flexibility in terms of design. I think we had some relaxation on the heights. Originally in the central space, we've planned out for a 6-story intensification of the site, but because the idea was, the private sector idea was to do more of a bigger public space, we've also allowed that to proceed and to happen. And also to extend out the connection between the MRT and the development, so that instead of just at a couple of single points of connection, the whole side of the station was allowed to be opened up and more well integrated with the basement structure of the development. So that's where the public sector can exercise flexibility. And through the guidelines of the public space that was provided in that, we went on to develop further guidelines to encourage more privately owned public spaces to happen within the space, within the rest of the city, and provide incentives and guidelines. So in a way, it's a dialogue and conversation of the private sector with the public sector to enhance the guidelines and enhance the provisioning of some of these spaces. And for the areas where we don't have the mechanism of the public state land, we have put out incentives. You look at the magnitude of 25 to 30% upside on the floor area. This is to encourage the redevelopment of the older business stock where we don't have the ownership of the land, to put it into the private sector hands, to give them a boost, to encourage that redevelopment to happen. And the redevelopment needs to be targeted. So it's really about providing that incentive to encourage the use of residential hotel and all that vision that we had about a more mixed-use CBD. Another example, this one from Capital Land, which is encouraging the conversion of a car park hub to a mixed-use development. And again, this plays to our overall vision for the CBD, which is a more car-like precinct. So redeveloping of the car park structure will help remove the existing business, the car park stock from the area, encourage new office space to come in, and new mixed use to happen in the CBD. And together with the incentive scheme, we also want to lay out very clear public contributions that we hope to see through the redevelopment. So in our guidelines, we spell out what do we hope to see, and that provides clarity and transparency. So the developers know what they need to come in to earn the incentive, and we know that the whole environment can become a lot more positive, a lot more attractive for the users in the area. So beyond that, we also have other types of contributions that we hope to see, whether it's making the whole street block more porous through the connections as well as the through block links. But ultimately, the city is such a dynamic situation and it's a complex environment. So we really want to work with the stakeholders, whether it's the community, the developers, the people on the ground that know what the situation is, to get them to work with us to make the whole place more vibrant and more exciting. That's why in recent years, we've been working harder to get the business improvement districts together. At the moment, we are piloting about 10 business improvement districts with co-funding from the state to encourage the private sector to get together, to think about their precinct, what are the improvements, both in terms of programming and in terms of infrastructure that we can do to make the place more vibrant and active. We are also working with the community a lot closer, together with the developers, to understand the ground situation, because ultimately it's about people on the ground. So the public and the private sector need to come together to have a shared understanding of what's going on the ground. And it's also about having a dialogue to understand the things that are happening. And Singapore is known for its greenery. I think many of you have been there and enjoy the greenery. And recently you've seen this phenomenon of not just street side greenery, but building level, vertical greenery. And we are doing a lot more to encourage it, and we're doing it in partnership with the private sector. So through working with the private sector, we've been managing to improve the guidelines that we put out on green buildings, improve the technology that goes behind the green buildings. Our National Parks Board has been working very hard to improve the know-how in the industry, as well as make it cost-efficient and cost-effective to have greenery, vertical greenery, and make sure the industry is developed in this regard. And the guidelines that you see have gone through 3 iterations to constantly try to improve and make sure that we are in sync with the private sector in terms of what we are looking for, and that they're helping us to achieve it on the ground. So ultimately, planning is a collaborative effort. It is a public sector, private sector partnership, and we want to develop the shared values that we have to make the place effective and work towards making it an attractive environment for all the people that live in the city and all the people that come visit us in Singapore. Thank you.
So I'm David Joy. I'm the ex-Chief Executive of London Continental Railways, LCR. I'm going to run through broadly who LCR are, LCR's regeneration approach, and then I'll move into a couple of case studies, Stratford City in London and King's Cross in London, drawing out the public-private partnership aspects of the schemes. So London Continental Railways, we were a private sector partnership originally. But very early on in the late 90s, we were taken over by the Department of Transport, UK government, and we became a publicly owned company to deliver the high-speed railway from London to the Channel Tunnel, which then led the trains on to Paris and Brussels. We also owned Eurostar, which was the train operating company, UK side of that business. So we worked through, we built the railway and opened it in 2007, and we sold the concession company to Canadian pension funds in 2010, and we reconstituted the company as a property company owned by the Department of Transport in 2011, and that's when I became chief executive, having been development director before that. So that's the brief history. We call ourselves LCR now because we're no longer just London. We haven't got a railway, and we don't go to the continent anymore because we haven't got a train operating company because we sold that as well. So it's LCR. And we had a review, government reviews all its publicly owned companies every 5 years. Ours was done in 2015, and then we were given a new remit. And our remit as a property-owning public company was to obviously maximise the value of the assets, and then also bring in the broader government objectives of delivering homes, jobs and investment on and around those property assets as part of a government aspiration. So the remit there is to deliver on the assets that we own, to work with the Department of Transport and help them with their property services, provide support for High Speed 2, which is the line going from London to the northern cities, which is currently under construction and in the first phase and under planning in the second phase, and then work with the cities around delivering homes, jobs and investment on and around those stations. So our approach for regeneration, which we established fairly early on, was to recognise that the projects we're working on are long-term and that they deliver and have to respond to changing economic circumstance and political cycles. So our developments are based around major transport infrastructure. They require long-term patient capital and investment, both from the private sector and the public sector. And as they are long-term projects, they need to be responsive to change and approach. And primarily, we were there to leverage publicly land that's owned in the public sector, but using that land as equity into the private sector so that we formed long-term supporting partnerships, and also to capture some of the land value increase around the infrastructure that's been invested by the public sector. And we did this primarily by securing the land in the first place, either through land pooling or buying the land or using existingly owned government land. We established long-term planning frameworks as a company in terms of working with the regulatory planning regime so that there was a flexible planning framework generally in place before we went out and found a private sector partner. But the key to our success really is finding the right partner with long-term vision and a partner that will work with us over changing cycles and be a prudent investor. Flexibility was key in that approach. And we recognised that from the public sector side, we had to share the risk, which isn't always acceptable to the public sector, but we were a bit more flexible. And these long-term projects required some interim use because the sites are large and they're long-term, so we looked at how we could use the sites in the short term as well as planning the long term. And the key to the whole success was establishing enduring partnerships. So moving on to my first case study, which is Stratford City in East London. The plan shows the location of Stratford within London on the right-hand side. On the left-hand side, we're a little island off Europe. So this was the site when we acquired it in 1996, old derelict industrial land with distribution depots. The high-speed railway that we were planning was being cut through the middle of that, as you can see on the right-hand side, in a box. This was the box under construction in 2004. We used the spoil coming out of the tunnels, which were going east and west from the box, to raise the land up and resolve contamination issues, and also the material coming out of the box to deliver a development platform. So 2007, the site looked like this. When we took property agents along to look at the site, they said we'd be lucky to get retail warehouses and distribution centres. We had a different vision. We had a vision of a new city, a new piece of metropolitan city centre. We selected UK partners, Chelsfield and Stanhope, as our development partners in 1998, and we jointly planned the 13.5 million square feet of Stratford City with them through to getting planning permission in 2005. Unfortunately, they fell apart. The Olympics came along and we restructured the deal. Chelsfield and Stanhope fell out of the picture. Westfield came into the picture through an interest in Chelsfield. We sold the residential element of the scheme to the Olympic Delivery Authority, and LCR were left with a commercial element to come after the Olympics. So Westfield started building the shopping centre in 2008, 2009 to be opened before the Olympics. So London Olympics happened in 2012. Then to do the post-2012 development, we set up a joint venture with Lendlease. We selected them as our development partner. We put the land in. Lendlease put equity in. We created the International Quarter City Development Company, and as 50-50 owners of that company, we moved forward to deliver the development around a new planning framework, and Lendlease were appointed as our asset managers, development managers. So the 50-50 partnership was to develop 4 million square feet, which was the remaining element of the 13.5 million square feet originally developed, originally got planning permission for. So it formed the new gateway to the Olympic Park, Queen Elizabeth Park, which was the post-Olympic parkland. So this was development in 2018, where you can see the Olympic Stadium in the foreground, and where the cranes are. That was our first phase of the International Quarter, 330 residential apartments in 2 blocks, a new headquarters for the Financial Conduct Authority, UK Financial Conduct Authority, and Transport for London headquarters building under construction there. So moving rapidly on to King's Cross, located just to the north of the city centre in London. It was a history of railway provision.
Speak up a little bit. Yeah.
The site was put together between us and another owner, who were NFC, provided 67 acres of land for development. The land pooling took place in 2001. There was a lot of history on the site, a lot of objections, and a lot of action groups. We responded by bringing those into part of the planning process. We formed a joint venture with Argent and Hermes through a competition. There again, we used the same model where we put the land in. Hermes, who is the British Telecom Pension Fund, put the money in to match the land value. We formed the King's Cross Partnership. Argent were appointed as the development managers, and we produced a master plan for 8 million square feet. We got planning permission for that in 2008. That was the original state of the site. 2008 was once the railway was completed into St Pancras. And we rapidly developed the scheme through providing fantastic public realm, a university arts as part of the driving force for it, and a mixture of 5 million square feet of commercial and 2 million square feet of residential. And today the scheme is reaching over 50% completion, with new headquarters, UK headquarters for Google, a new headquarters for Facebook. So it's becoming the tech digital centre for London. So all the way through our projects, we provided partnerships with the private sector on delivery, partnerships on land assembly, and partnerships with the international private sector. That's me. Thank you.
So thank you, David. Thank you, Yu-Ning. We'll hope to get questions from the audience, which are going to come up on this iPad. But before we go to those, and I think we have about 10, 15 minutes, starting with a question for you, David, about King's Cross and similar developments. Since those projects can last, and I imagine HS2 will be 10, 15,
20.
maybe more 20 years. And I know the Lend-Lease people are looking ahead, hoping that it won't take 30 years. But in such projects where you could anticipate a change of government, multi-changes of government, both of the mayor, of the parliament, and changes in policy, and also, of course, ups and downs in the cycle, maybe some quite severe ones. How does a public-private partnership withstand those kinds of stresses and strains? How do you maintain a flexibility where, in the beginning, it's important to have some firm agreements that might otherwise bind the parties?
Yeah, there are two elements to that. There's the certainty of the provision of the railway infrastructure, and to get that certainty, you need cross-party support, so that if a government change, the next government is already bound into that provision. So in terms of the long-term infrastructure, there needs to be certainty on that, because the investors and the development partners, private sector development partners, are looking for that certainty of delivery on the infrastructure. So that's on the public investment in the infrastructure side. Where we're land partners and formed a joint development company as an equity interest in a development company, then it's really having a partner that can absorb risk and manage risk alongside the public sector partner in that. So it's making sure that you're prudent in your investments in a normal property investment and development manner, and ensuring that you're ready when the cycle is ready, and that you're not waiting for public sector decisions or other uncertainties to occur. So it's having all the stars align, ready when the market's ready, and that's why you have a private sector partner that kind of has that perspective on being able to develop in a commercial manner.
But did you find yourself in big renegotiations that had to take place?
You can be, yes. And as you saw in Stratford, we had a development partner in Chelsfield and Stanhope, and they fell apart, and then we had to restructure the deal. The Olympics came along. So it's having that flexibility and adaptability to the changing circumstances to deliver the original vision and the original aspiration for the master plan.
Great. And Yu-Ning, a question about development in Singapore, and clearly there's been a great variety achieved of architecture, of program, of urbanism in the various sites that now wind their way around Marina Bay and many other parts of Singapore. But do you find, as a planner in the midst of all of this growth and change, that there is some danger to over-planning? Does that ever come into the discussion of, in some cases, the free hand of the market can create chaos, but it can also create a liveliness. Is that an issue that is discussed a lot within the ORA or the community of developers who come to or are already to Singapore?
Yeah, certainly that's always something that we are concerned about, that we don't want to overplan because we don't know everything that we need to know in terms of real estate and development, which is also why we come to forums like this to better understand what's going on in terms of global trends and markets. But certainly in terms of planning, on one hand, we are very constrained in Singapore in terms of our land and what we have. So we do want to be judicious in doing the plans. But we also recognize that in development, we need to work very closely with the private sector to tap on their understanding of what the market needs and the entrepreneurship that they have. So I would say that it needs to be a dialogue and a conversation, and beyond with the developers, also with the larger community, to understand where people's aspirations are and what they hope to see. So as much as we want to plan and provide some certainty on some levels. We also want to give flexibility on other levels. Whether it's in the government land sale sites that we put out, we try to prescribe certain planning parameters, whether it's certain percentage of, say, office use, to give some clarity that that's the vision that we're looking for. It's generally for office, but we want to give other flexibility for other types of users to be introduced so that there can be an interesting product. And I believe that in the importance of having dialogue, because even as we plan for the regeneration of the existing CBD, we had a lot of dialogue with the existing real estate players in the area, as well as the larger community in general, to understand whether that's something that they also hope to see in the area. And as we develop some of the guidelines that we have in mind, we also kind of test run and run it by certain people to see whether that resonates and that's going to make sense, which is why you see some of the green guidelines that we have out there also go through many iterations, because as developers use those guidelines, as architects try to work with those guidelines, so where are the gaps and how else can we improve and make that better?
Do you find yourself overhauling the URA process from time to time? Because the URA also has to change.
Certainly, we do try to stay nimble and do try to adjust ourselves along the way. So a good example is in Marina Bay. When we first sold it, in fact, we gave full flexibility for the site to be entirely what we call white, which is there's a GFA, there's a gross floor area, but there's no specific use. But the developers came back to us and say, you know, you got to give us some clarity on what is the general use going to be in this area, right, so that they know what to anticipate for the next guy and the other neighbors around them.
Right. So let me go to a couple of questions from the audience. First, what if the government has absolute domination in the dialogue or even not open for collaboration? Mm-hmm. A general question, perhaps, about public-private partnerships.
So I think it's very dependent on the nature of government and their aspirations and obviously the context that they're working in. In terms of London, there's the public sector policy and regulatory side of the public sector, but we were on the central government ownership side of the equation. So in terms of being able to take more risks and being able to participate more with the private sector, we had a bit more freedom than if you're in the local government regulatory side of the equation. So they're very different forms of public-private partnership depending on where you sit and the terms. And as you were saying, there are many different aspects of the public sector and different public sector players. So they'll have different ways of getting involved, either through participation or through the regulatory side.
Well, I would say it would not make sense, because ultimately the urban environment is about a collaborative process, and the government doesn't know everything, and we are not building out all the buildings in the area, even as we may build some of the infrastructure in the area. So it has to be collaborative, because then that's where the product would make sense. And we also have to adjust along the way, because circumstances change, and like David said, the market may change and all that. So we got to adjust along the way, right, and make the environment work for everyone, right, because the product is what's important.
I think it's also a mark of some success in Singapore that you've managed to welcome, invite, attract foreign, not just investors, but developers, such as Hong Kong
right,
Land, others, into the area. So, which is not so easy to do, and that's explains something about the accessibility of and the transparency, of course. If I could go to one more question, if we have time, it's about the UK. In UK, maybe if UK, in UK stopped doing PPPs as Kirka 10 years down the line, there were big problems: lack of investment, large dividends being paid, product being defective. Why do it? So, I guess you could read for yourselves, decode that question.
Yeah, I think there are a number of different sorts of public-private partnerships in the UK. Public-private partnerships in terms of delivering schools or other public infrastructure through those sorts of mechanisms have been questioned. Our kind of public-private partnership was a very different sort. It was an equity investment and a land investment and a long-term relationship where it was truly 50-50 ownership of a development company. And so we were sharing the risks and sharing the decisions and sharing the commercial aspects as a truly open position, whereas a lot of the PPPs to deliver social infrastructure were more contractual PPPs rather than true deep partnerships sharing the same objectives.
So thanks. I think that brings us to a close. Just want to say, having heard some of the previous panel's discussion of very large-scale, formidable problems that have to do with the environment, with resiliency, with a very challenging future, I can only imagine that some of the responses called for will require more and more of this kind of public and private coming together to help each other to absorb risk and make a positive change. So thank you very much. It's great to hear from you both.
Thank you, James.